Hi, thanks for joining today. Today I'm going to discuss the top 6 credit mistakes that people make when buying a house that could actually turn to cost them thousands of dollars. So hopefully I can answer all of your questions and be able to get you from being worried about your credit or not understanding it to being able to be confident to be able to go out and buy your first home. Thanks again for joining. And should you have any questions, there are links throughout the presentation where you can reach out to me personally and ask any direct questions that you may have. Thanks again for joining. Okay, let's get into the presentation. So, when you think of credit, do you feel confused about your score? Are you stressed over the whole process of credit? Are you overwhelmed, not sure what you actually need to do to increase your score or what's actually affecting it or how to increase it? And are you uncertain of what the right path is? Are you seeing yourself making on-time payments, but your score is staying the same or even going down? Or you don't use it and you have terrible credit and don't understand why? Don't worry, because my team is here to help and I'm here to answer any questions that you may have. So let's talk about credit as a whole first and foremost. What is credit? Credit is a bilateral contract between you and the company or person extending credit. Typically, there is an interest rate associated with it, and along with payments and the expectation that you're going to pay it back. Credit only works because it's a trust agreement at the end of the day. And it is an agreement, and you are responsible to repay that debt, even if you were co-signing for somebody's loan or for, let's say, a house or something to help somebody to get qualified. At the end of the day, remember, it is yours obligation also in addition to theirs. So let's look at credit. Credit scores are the foundation to your getting a credit card, getting approved, your interest rates. When it comes to buying a home, the interest rates, a car, and to obtain a loan with the lowest amount of points possible. So, who am I? I am Karen Ziska. I am a licensed loan originator with Neighborhood Loans. I have been in the real estate and lending industry since 2001. In my career, I have been an asset manager, and between real estate, asset managing, and financing, I've helped to finance and sell and negotiate over 10,000 homes in my history. So I've helped a lot of people go from wanting to buy to being able to buy. So let's talk about, and it helps if I turn off the pop-ups. So let's talk about dreams do come true. So no credit is ever to the point where it cannot be fixed. With time and the right steps, all credit can be corrected and everybody can get to the score that they want. It's just getting to a point where it may not necessarily be overnight, but following the steps and following the path, you will see an improvement and you will get your score up. So if you're feeling discouraged, you're feeling let down, you feel like you've tried everything, let's try the common sense approach of what's actually worked to get people up. So I had a first-time home buyer came to me. Her credit score was 551. She was very discouraged, but she was determined. I set her on a plan to tell her step by step what to do. With it was 6 simple steps, and all she had to do was follow them and then wait. Fast forward the 6 months, her score was up over 680. She was into her dream home, and the bonus was she came to close with only 1%. So it can be done. So trust the process, and we will get you sold and into a home. So let's look at credit. What does a credit score actually mean? So credit scores can have the lowest score of a 0, believe it or not, and they go up to 850. So it's the range in between. Depending on what type of loan that you're going for, they will have different thresholds or different scores that are required. So, when it comes to mortgage lending, as a mortgage lender, I use what's called a tri-merged report. So, with that report, we're looking at Equifax, Experian, and TransUnion. And we are using the middle score of the three different bureaus. So we take the high score and throw it out, we throw out the low score, and we're only using the middle. Now, the middle is different for everybody. Some people, Experian might be higher or in the middle. Some people might be TransUnion. So your case is dependent on you. So to have an accurate analysis, we would have to take a look and see where your score is and what steps we need to do to increase them. So, when looking at a mortgage application versus a credit card application, it's key to know that as a mortgage lender, the FICO score that I use and that I see is not the same as the Vantage score that your credit card provider or car loan provider will use to analyze your credit. So know that the FICO score tendency has been that they're looking back over a 7-year period. They're going to look at repayment history and they're going to look at on-time payments. They're going to look at overall utilization. So when you're looking on your bank or Credit Karma, it may not match with what we see. It doesn't mean that it's wrong. It's just a different version. So let's look at what really affects your credit score. So the thing that affects it the least is new credit and inquiries. So that's only about 10% of your score. Credit mix, the diversity of the type of credit that you have, whether it's an installment loan, a mortgage, or a revolving, which is like a credit card. 15% of your score is length of history. So why is this important? If you have a credit card, but you don't really use it, don't close them, keep it open, and then you'll want to use it every quarter or every 6 months because you want to keep your credit cards open to show a longer length of history for having credit extended to yourself. 30% is actually what you owe versus what your limit is. So that's called your utilization. And 35% of your score is your on-time payment history. So when you look at your credit as a whole, take a look and see, am I overusing the credit card? Did I miss some payments? Or is it brand new? If you get to where you're making on-time payments consistently and you're keeping your utilization low and keeping it up, you're looking at the total mass amount of the largest sections of your credit will help to drive your score up. So when correcting credit, these are the key areas that we focus on to ensure that you're building good, solid credit as your foundation. So the mistake that I hear a lot that people make is they feel like if they just pay down their balances and they pay down their collections, their score will immediately go up. Well, let's take a look at how long it actually takes once you make a payment for your score to actually go up. So with, first we're going to look at types of credit, sorry. Revolving credit. A revolving credit is like a credit card. So you have a limit that's open that you can charge up. Once you make payments, then your credit limit then is re-extended back to that maximum. If let's say your credit limit is $1,000, you charge up the $1,000, well, now you've used it all. So with revolving, you're going to use it and pay it. Now, when you have a late payment for a revolving card, if you have average credit, you could see a drop of 80 points from 1 month late payment. And if you have good credit, you can see up to a 110-point drop. So you can see how missing a payment could have a huge impact on your credit for just missing that one payment. So let's look at installment loans. Installment loans are loans that have a fixed amount and you're making installed payments, and once it's paid off, it's gone. So some examples of that are car loans, personal loans, and student loans. So the key difference between installment and a revolving is revolving, your limit or your availability of credit stays. And while you're making those payments, you are able to reestablish it. Once you finish with an installment loan, it's done, it's paid for, and it's closed. So let's look at how big of a hit it is when you miss something with an installment. So you can see a 100-point hit if you were to miss a car payment. And when when it's time to try and fix credit after hitting an installment, you'll see in the next couple of slides, it takes longer for installments to report and actually turn back positive. So you want to make sure that you're keeping those installments in check and on time. So with a mortgage loan is a specific type of specific type of credit that is used to purchase real estate. It is a long-term loan. It's 30 years typically is the length of time. Now there are shorter terms that you can get, but most people get 30-year. So when we're looking at mortgages, you could have fixed rate and you can have adjustable rate or an ARM loan as they're called. There's FHA, there's VA, there's conventional, there's USDA, and there are non-conforming loans. So mortgages versus other types of installment, it is a larger loan and it's a longer period. And it will also have fixed payments if you choose a fixed rate loan. If you choose an adjustable rate, your principal and interest payments can fluctuate through the life of the loan. So you just want to make sure that you're getting into a loan that you're financially comfortable with. If you were to miss any payments, you could see a 150-point drop if you were late on your mortgage. So if that were to happen, it can be recovered from. It's just going to take a little bit longer in that case. So let's look at how long does it actually take to rebuild credit once you miss a payment. So if you have a revolving account like a credit card that you were late on, it could take 1 to 2 months before you could see your score going up. And remember, not all credit cards report to the credit bureaus every single month. So it may take 30 to 60 days, but don't be surprised if it could be 90 or 120, depending on when your credit card reports. With an installment loan, you can see a difference typically in about 1 to 3 months. With the delay of reporting to the credit bureaus, it could take longer. Just know that installments are slower to help to increase your credit once you miss a payment and you start making on-time payments. It's a slower process to get it kind of back on track. So with credit cards and installment loans, you do want to know when they report. Reason why is if you know that you're going to be late on your car payment, you're going to want to know when are they going to report so you can work to get that payment made prior. Same with your credit card. You're going to want to know if, especially while you're rebuilding credit, when they report, because you want to make sure your utilization is below 30% of your credit limit. Once you start going over 50% of your credit limit, it actually starts taking points away from you. So collections, sometimes collections paying them can result in a temporary drop of your score. So what I always tell clients is prior to paying any collections, let's take a look at your credit. Let's put it through a simulator and see if you need to pay it or if it's going to affect your score. So when you pay a collection, it won't re-age the account, but sometimes it can show activity, which therefore then has a negative effect on your credit. So it could show a change in account status, which just shows new activity, and that's why it could impact your score. So again, only pay collections after we've done a deep dive, looked at your credit and said, yes, this is something you need to do. Don't feel like you have to pay every collection to raise your score because chances are it's one of the other factors that's affecting your credit: overutilization, missed payments, or length of history. So let's talk about disputes. So many people come to me with loan applications and they have every single thing disputed on their credit. So they clicked on something that said, oh, I can fix your credit overnight. Just pay me a couple $100,000, whatever the case may be, and I'm your savior. If it sounds too good to be true, it probably is. So let's talk about disputing negative items on your credit that are actually accurate and legitimately yours. You don't want to do it because one, it's unlikely to work. The way that the process works is somebody writes a dispute letter, they send it to the creditor, they're hoping and praying that the creditor doesn't respond within 30 days, and then they can fight to get that item removed. Can it happen? Yes. Is it likely to happen? No. And does the creditor have the ability to put it back on your credit after the fact? Yes, they do. Because even if you had it disputed, you were able to get it removed, there is Fair Credit Reporting Act that the creditor can put it back on your credit if it was somehow missed when it was removed. And it can backfire because when you go to a lender and you see everything disputed and we say, what happened? It's showing that you're trying to cheat the system or be deceitful. So you want to make sure that you're going in with an honest application, an honest credit report. And also, what happens is when you dispute stuff, it will basically hide that item from the algorithm. You're going to see a false high credit score. And when we do the loan, depending on the age of the item, we may have to have you remove those disputes. So recently I had a lady come to me, she wanted to buy a house and her credit score was 580, which is great. We can do that with a conventional loan. She had a bunch of new collections that were under 24 months and she had them all disputed. Once I put it in the simulator to remove those disputes, her score was actually 504. So she had her hopes up. She was very hopeful that she was going to be able to buy a house, just to be put back into reality that she actually has to work to get these items corrected. And it's going to take her 7, 8 months to get her score up. She will get there, but she's also spent all this time and money getting these items disputed rather than actually just fixing what was actually on her credit. So you don't want to damage your credibility and you want to focus your time, effort, and energy and money, honestly, on resolution, not a magic trick. So when you want to file a dispute, and you want to do it if you believe there's an error, there's 5 different categories of why you can dispute something. If it's legitimate, then by all means, definitely dispute it, work with the creditors to get it corrected. Again, they have 30 days to investigate after that dispute. And if they provide evidence that the debt is yours, while the item still shows disputed on your credit, it will show resolved by creditor on the report that we see. So basically what they've said is we've proven that this debt is in fact this person's. So looking at when you can dispute items. So if the balance is incorrect, now if it's been where you've made a couple of payments and the balance is off by a little, that's not worth disputing it. It would be like if you knew your balance was, let's say, 1,000 and it's showing 10,000, or it's a card that you know you never use and there's a balance on it, then dispute it, because it could be that the credit card company is just behind on reporting to the bureaus. Wrong account information. Let's say you have a Citibank card and your card ends in 645, but you see something that says 123 on the credit report and you say, okay, that's not mine. Then you dispute it. Not your account. Let's say you have no knowledge of a card, you never opened it, you never bought the car, then you can dispute it. If you see a creditor has re-aged your account, so creditors have the right and the ability to sell your debt. So if a debt collection company takes and acquires your debt. If that debt is, let's say, 6 years old and or 6.5 years old, and the new debt collection company takes it and they say, oh no, it's not 6.5 years old, it's only 6 months old, then you have the ability to dispute it because they cannot change the date of the item. They can just try to collect. So when should you not dispute? If the debt is accurate, if you're trying to remove it just because it's a collection, and if you're trying to get a mortgage and you think that's going to somehow help. So bottom line, dispute what is actually needed to be disputed. Focused on resolution. Don't focus on a magic item. So if you do need to dispute something, this website down here at the bottom that has a Consumer Finance Gov, they will have form letters that you can use to dispute. They will walk you through what can be disputed, and there is a wealth of information. So use these tools that are available if you legitimately need to dispute something and have valid reason to do so. So, mistake number 3, this is the biggest one that comes across regularly, is that the inquiries are what's causing your score to be low. Well, let me debunk that. That if you are avoiding getting help because you're worried about the inquiry, chances are you've already done way more damage than the inquiry will do. So an inquiry is going to be about 3 to 5 points. That will not prevent you from getting a loan with that few of point difference. And when you make your payments the next month, your score is going to go right back up. So that inquiry isn't going to make or break your credit or loan situation. And anything we tell you to do is going to help increase your credit and get you to where you want to be. Now, where you'll see a drop in your credit score is if I pull it for a mortgage, then the auto show is in town and you think, hey, maybe I'll go buy a new car. So you have it run for that. Oh, wait, the RV show is in town. Maybe we'll go get an RV instead. Now you have multiple different industries that are pulling your credit. There you may see a difference in your score in it dropping. But for one lender to pull your credit, you will not have a huge impact on your credit. And again, that's only 10% of your score. Is your utilization too high? Are you not making on-time payments? And is your length of history not long enough? Those are the things you want to focus on. So again, remember the new credit is 10% only. The items that are impacting it, payment history, utilization, focus on those items. So believing that credit can be fixed overnight or that there's a magic person or company there, remember, it's not a shortcut, it's a process. It does take discipline, it takes on-time payments and smart financial decisions that are done over time. So it's very important, know where you stand. Work with either myself or somebody that can go through your credit with you line item by line item. If you see that it's overutilization that's causing your score to be low, then one method that will work to get your credit or to get your utilization in check is the snowball method of debt reduction. You win with momentum, you see results quickly with using this method. So, if it's overutilization, let's talk about what is the snowball method and how does it work. Take all of your debts, write them all down in order of balance. We have from the lowest to the biggest. And ignore the interest rates for now. That method's called avalanche method. We'll just focus on snowball because people like to see wins. They like to see accomplishments. And I found that with all of my clients that snowball works the best. So what you're going to do is you're going to make all of your minimum monthly payments on time. Now, you're going to need extra money that you're going to have available to attack this debt. So you're going to take an extra amount that you have. Let's say it's $100. Let's say it's 150. You're going to make all your minimum payments on all your cards and take that extra 100 or 150 and apply it to the card with the lowest balance first. And keep doing that every month. Once card one is paid off, then what you're going to do is you're, of course, going to celebrate your progress because this debt is paid off. But the next month, you're going to take the minimum payment from that first one plus your extra money and apply it to the second one that you have. And you're going to keep doing this monthly and keep it rolling because as you're paying off debts, you're getting more to apply towards the balances of the debt because you're paying them off and you have the extra monthly minimum payments from the other cards. But anytime you have extra money, apply it towards that next debt. So here you can see that you're going to make your payments and that once your loan is paid off, then you can see that you're making the same payments, but you're paying more towards each liability to then pay that item off faster. Because the goal is that we all pay less interest over time. Credit cards can have a 20, 24, 36% interest rate. So you want to get that interest so it's not accruing every single month. Now, I'm not saying don't use credit cards. You just want to use them wisely. Keep that utilization at 30% or less each month to keep your score up. So let's look at what happens if we don't improve our credit and how much it can cost. So if you're looking at, let's say, a $400,000 property, if you have excellent credit, you're looking at, for today's rates when this presentation was created, was about 6 1/8. Now, if you had poor credit, you're about 6 3/4. So the monthly payment difference from the one to the other is, so you have $2,400 for the lower rate, you have $2,600 for the higher rate. Now, doesn't seem like much on a monthly basis, right? Look at it and say, over 30 years, what does that look like? It's $77,000 difference. Now, I'm not saying put off buying your house until you get the best credit. Work to get better credit and then think of it as you're marrying the house and dating the rate. You can always refinance your rate into a different program once you get to where you're able to make, you improve your credit, then you can refinance, get a better rate down the line. So when you look at having a credit impact, here's another scenario. So you have a 740 credit score versus a 620. If you could get a 5.75 versus 6.25, you're looking at about $136,000. So, or I'm sorry, $136 per month. And the discount points are key. So you're going to pay higher discount points with the lower credit score than you would with a higher credit score. And now, if you have that $136 difference per month, if let's say you work to get your credit higher and you saw that savings, if you take that same $136 per month and apply it towards your mortgage as an extra principal payment, you're going to be able to pay off that loan instead of 25 years, or I'm sorry, instead of 30 years in 25 years. It's going to save you that 5 years of payments, but look at it, saved you $115,000 in interest by paying off your loan early. Whenever you have the ability to make extra payments towards your principal on your house, do it because it is helping to save interest over the long term of owning that home. Now, if for anyone saying, well, I'm not going to stay in my home 30 years or 25 years, it doesn't matter. Where it matters is you're applying this money towards your principal. So when you do sell the house, you will see that you are actually netting more from the sale because of paying off so much of your principal of your property. Now, if anyone has questions, here is the link to setting up a meeting with me. There is no cost, no obligation. I will answer any questions that you might have regarding credit, financing, mortgages, whatever you need help with, let me know. I'm truly here to be a resource for you and answer questions without any pressure or any obligation. So, to increase your credit score, it's not only, again, opening cards, and it's not opening more of them. So sometimes I'll have people say, well, I just opened 5 credit cards. More is not better. Let's get a good foundation started. Open your cards responsibly and wisely. You want to diversify your credit mix because it does help. So you'll have a credit card, you'll have an installment loan, like a personal loan or a car loan, or let's say student loans, start making your payments on those, or mortgages. You'll see that that mix does help you, and use it responsibly. Again, keep the limits at 30% or less. If you go over 50, know when they report so you can make a payment before they report so that overutilization doesn't hit your credit. And with that, maintain those cards. Don't cut them up once you pay them off. Think of it as, hey, I'm going to put them, I'm going to put them in a drawer and ignore them for a little bit, but you want to make sure to keep them open. Now, paying on student loans. Paying on student loans, if anybody has them that have been in deferment for years, the benefit of paying on them is, let's say you get on an income-based plan where you're paying $5 a month. Great, because that $5 is going to show good payment history on a debt that's old, and it's going to show positive payments. So, it's a win-win to establish credit history by utilizing student loans and having them work for your benefit. So if you have thin credit or limited credit, download the Experian app. They have a service called Experian Boost. I use it all the time for my clients. It is a huge advantage, and it does help to raise your Experian score. So remember, when we look at credit reports, we're looking at the 3 bureaus. So doing Experian Boost will help get your Experian up. Then you only need to focus on getting the other 2 up to where you wanted to be. So if you're an authorized user on someone's credit, can it hurt your credit? Yes, it definitely can. And I will go over why. And authorized user accounts are not the answer to raising your credit. I've seen on social media, there's a fair amount of clickbait of, hey, boost your credit, get active trade lines, pay me this. And people will add you to their credit or to their accounts as authorized users. The underwriter will ask, is this your debt? Is it a family member? Are you financially contributing to this debt? If you cannot prove that you are financially contributing to those payments, chances are the underwriter is going to ask for you to remove yourself as an authorized user, get updated credit scores that show what your actual credit score is. Because yes, authorized user accounts can boost your credit, but it's like disputing it. It's a fake number. We need actual numbers. So they do have limited impact on being an authorized user. And again, you want to show that you actually are legally bound or making payments on that card. And it doesn't necessarily build diversified credit because it's not really your credit. You're just kind of tagging along on somebody else's. The risk of a negative impact if they overutilize that card. Let's say it's a $500 credit limit and their brakes go out on their car and they have to charge $1,500 on it. Well, it's going to show that card way overutilized. It may not be a big impact on them because their credit may be higher to start with, or they may have more trade lines than you, but it's going to have a big impact on your score. So you don't want to tie yourself up with somebody that you don't necessarily have control over their spending habits. So establishing your own credit is key because you want to open, manage, and maintain your own credit. So if you think past bad credit events will prevent you from buying a house, think again. The lending industry is pretty lenient when it comes to bad credit because everyone knows things happen. It's just what is the time to get you from A to B. So, under the right conditions, you may still be able to qualify for an FHA, VA, or USDA loan while still in Chapter 13. So, let's look at the waiting periods after something catastrophic has happened. So, while you're in a bankruptcy, if you're in Chapter 13, after you've made 12 months of on time payments, then, and you can prove that you've made 12 months of payments, then you can get qualified for an FHA, USDA, VA loan because you are showing that you're making on time payments. Now, once that loan is dismissed, or discharge, it's a 2-year waiting period. So, and when you're making your payments, please, please, please make sure that you're making your Chapter 13 payments on time, which means prior to the last day of the month, prior to 5 p.m. Real world case scenario, I had a client that she made her payment. It was 7 o'clock on a Friday night. It was the end of the month, was like Saturday or Sunday, and they didn't report until Monday that they received the money. She then had to start the clock over. So you want to make sure that you're making those payments early and on time. If you're buying after a Chapter 7, then it is a 2-year waiting period with an FHA loan. If you're doing a conventional loan, Chapter 13 is 2 years, Chapter 7 is 4 years. So let's talk about the different types of loans real quick. So we have conventional and conventional renovation. Yes, there is a conventional renovation. There's a misconception that the only type of renovation loans are an FHA 203K, but that's not the case. There is conventional. There's also, and then FHA and FHA renovation, which most people know, VA and VA renovation. So our veterans, if you want to buy a property, let's say it's pink tub, blue toilet, shag carpet, as long as the rehab is under $75,000 and nothing structural, we can do a VA renovation loan and it's still 0% down. Importantly, if you're going to look at buying a FHA foreclosure or a HUD property with a HUD $100 down program, you can buy a HUD foreclosed home and buy it if it's move-in ready, or use it to buy it plus renovate it with $100 down. USDA is a 100% loan. That's for rural areas. The property does need to qualify and as far as being in a USDA approved area, and there are credit score requirements, which we'll see in a minute. Reverse mortgages for our people that are 62 and older. Reverse mortgage, you can buy a home, you can refinance the house you have with a reverse mortgage and have that liquidity available to you where you're not making a monthly payment. You are responsible for your insurance and taxes. Non-qualified mortgage, there's a few of them. Those are more creative loans that if you don't fit in the top row box of traditional loans, then the non-qualified mortgage is a more creative type loan. So we're looking at DSCR loans, which are debt service coverage ratio loans for our investors, self-employed loans, which are 1099 loans, and then there are bank statement loans and the 1099 also. So what scores are needed for a loan? Minimum credit score for an FHA loan technically is 500, so you do need 10% down. 580 with 3.5% down. Larger loan limits. So every year the loan limits do creep up. So the good thing is years ago it was like 300. Now we're up to 541, 287. An FHA loan is ideal for buyers with lower credit scores, limited income where you need to go to a higher debt to income ratio. The FHA loans, mortgage insurance does stay for the life of the loan. Unless you put 20% down, then you hold it for 10 years. Conventional loan is a loan limit at 832. Freddie Mac requires a credit score at 620. Fannie Mae has implemented a common sense approach for loans, and what they're doing is they're not necessarily focused on a credit score. They're looking at your total credit history and your total credit picture. With a VA loan, that's going to vary by lender. Technically, VA does not have a credit score requirement. However, a lot of lenders do require at least 580 to 620. There is no loan limit if you have full entitlement. For our veteran members that have disability, if you are disabled, then you will waive or you're exempt from the VA funding fee. And a lot of municipalities do not require you to pay real estate tax if you are disabled. However, check with the county you're buying in. If taxes are paid in arrears, which means you're paying for this year for last year's taxes, in that case, then the escrows get set up with the tax in place. But if the taxes are already at zero, then they would stay at zero. And with a USDA loan, it is a credit score requirement of 640. And the loan limit is going to depend on the county where you're buying. So you will want to look it up on the USDA website to see what is the loan limit amount. In Illinois, there's a county called Kane County. The limit there is 324. So you can see if somebody's trying to decide, should I go with an FHA loan or a USDA loan? If they qualified for both, then or a conventional loan, looking at the loan limit is key to know which loan program that you want to use. Jumbo loans, which are loans that are above the 832 for conventional, they require 680 to 700. Non-qualified mortgages, those creative loans, typically require 660 or higher. They are going to go up to a higher loan amount. For us, the ones that we use, they go up to $3 million. Reverse mortgages do have a loan limit of 1.149. Again, there is no credit score requirement for those. So let's look at down payment assistance. What are the key things that you need to know about down payment assistance? It is a second loan. So when you move into a property, you're automatically moving in with a negative equity situation because you owe the first loan plus the second. Down payment assistance programs do have credit score requirements. In Illinois and Indiana, where I do most of my business, it is 640. They do have debt to income requirements. If your credit score is between 640 and 680, it's at 45%. If you're at 680 or higher, you could go up to 50%. Income limits, depending on the program that you pick. Illinois has 4 down payment assistance programs. They each have their own income limit. Depending on which one you pick, they may have to get paid back in full or installment payments over time. They also do have housing price limits. So when you get qualified, you just want to know what are the requirements for the program that you're getting approved for. Let's look at grants. Grants are financial assistance that's provided by local government for first-time buyers. Usually it's targeted to a specific area. They cover important costs like they can cover down payment, they can cover closing costs, and some repairs. But you will need to check for the area that you're getting a grant. It may or may not cover your real estate agent's commission. They do have eligibility requirements. Typically, they don't need to get paid back as long as you stay in the home for the determined time frame that is required. A lot of the grants are then forgiven. So if you have a specific grant, let's take a look at it and see what those requirements are to make sure that you're going into it and understand all aspects of it. So let's recap what we've learned today. Credit can be fixed. It can take time, but it can be fixed. Disputing items on your credit is not the answer. Inquiries are not what caused your score to be low. Chances are, remember, overutilization, not making on-time payments, and not having credit open that long. Not improving credit, as we've seen, can cost you hundreds of thousands of dollars. You want to get your credit up as fast as you can, and you want to maintain it and keep it up. Bad credit isn't the end of the world. We've all had life struggles. We've all had challenges. Let's get you from troubled to approved. So hopefully you can see that improving your credit will help you to purchase properties. It will help you to get better rates and have more opportunities for that credit. Now, I am offering free credit consultations at no cost with no obligation. What I would need you to do is schedule a link in with the link below, and let's put together a plan. Make sure that you mention that you were on this webinar, and go ahead and set up that appointment. And I thank you again for joining and attending, and I look forward to helping you. Should you need anything, feel free to reach out. I am here for you. Thanks again, and hope that you get into your home soon.